The one limiter to both the used and the fixed ops story is that the car park has not been growing much, and we have a lack of vehicles that are under 5 years of age, and that doesn't magically fix itself. We don't make new used vehicles. It takes time to matriculate through the marketplace. So dealers of all types are having to sell and service slightly older used vehicle to maintain the same volumes that they once had.
Today, I'm excited to chat once again with Jonathan Smoke, Chief Economist at Cox Automotive, where we dive into the turbulent 2024 car market and what shocks and surprises Q4 may have in store. A big thank you to our sponsors for making today's episode possible, Car Dealership Guy News and CDG Recruiting. And now let's get into the show. Jonathan Smoke back on the CDG podcast. Jonathan, welcome.
It's great to be back with you. It's been a while.
Yeah, our favorite DJ turned economist. I say you're full-time DJ, part-time economist. No, I'm just kidding. You're great at what you do. And we appreciate you coming on. Look, the last couple episodes, we've had 2 episodes in the past. I think one was maybe like a year ago, the other one 6 months. But they absolutely crushed because people love listening to your insights. In particular, people, want to know, where's the market heading? Where's the car industry going? It has such a big impact, especially over the last couple of years on the broader economy. And so I would safe to say this episode attracts a pretty large audience. We'll talk about the Fed, interest rates, affordability, EVs, inventory, the different brands, the market uncertainty with the political climate and many more things. So I like to say, let's explore our curiosity and see where it takes us. So how about we kick off? And if you can give us a quick background on yourself for those that don't know who you are or haven't listened to prior episodes.
Sure. Well, I am the chief economist for Cox. That basically means I lead a team of folks who our primary mission is to use the data that we have across Cox platforms, from Mannheim to all of our software platforms that dealer use, and our consumer-facing websites, Kelley Blue Book and Auto Trader, to basically make sense out of what is happening in the economy and how it's impacting the auto market, and then most importantly to make predictions about the future. Because business people need to have direction about where the hockey puck is going to be, not where it is right now per se. And so we've been through some really interesting times since I've been here. I've been at Cox almost 8 years. Prior to that, I spent over 20 years in various parts of real estate. And that's really where I cut my teeth and first became a chief economist, and also where I started doing the DJ thing, which is going back quite a bit. I was a DJ before. That's how I fell into that. And I love music. But I started incorporating music into presentations, and now I can't get away with any decent audience without having song selections.
That's great. You got to keep it fun. All right, so take us back. I like to start with some context before we get into outlook predictions, right? Let's just recap, if you can, the last 12, 18 months or so. Give us a little overview of what's happened.
Well, I think it's really good to start with just how has this year progressed, since we're, almost 80% or so through with the year. The year has largely turned out consistent with what we thought would happen. We knew this would be a pretty important year with regards to some milestones being achieved in the economy. Most importantly, that the end of the very high rate, tight monetary cycle would end and the Fed would start cutting. And that took a little bit longer than we anticipated, but now that milestone is behind us. We also have had the supply situation in the new vehicle market starting to really pick up and recover in the second half of last year and the second half of 2023. And we expected to see more growth in inventories and supply this year, and really just how aggressively that happened, we knew would then have an impact on just how how much we were returning to old standards for discounting, incentives, those kinds of things that are two sides of a coin for the industry. On the one hand, you want to see lower prices and more discounting and incentives in order to improve affordability, which has been limiting the market. So for the consumer, that's a good thing, but for dealers, that's a bad thing. For grosses on new vehicles in particular, which have been significantly different in the post-pandemic world, or during the pandemic and now the post-pandemic world. So we knew that tracking what was happening with dealer profitability, this would be a challenging year. Meanwhile, the road to electrification, we could see that this was going to be a big year with regards to supply growing, because we had over 30 models slated to be launched this year. We were already in an oversupply situation last year. So we expected this to, we use the phrase the year of more for EVs. And by that, we meant more models, but also more discounting, more marketing, more angst about the market. But we were convinced that we would see success in terms of growth of the marketplace. And that has happened. But we have also seen more hybrids. So, we may get into that too, but it definitely means that the march towards electrification continues. And then in the used car market, we expected this to be a very critical year to return to more normal trends, especially with seasonality and specifically the depreciation of vehicles. And I believe very strongly that the Manheim data is absolutely saying that we've reached that point. And that means that, we're through with the price correction on used vehicles. And it becomes more predictable and a more consistent part of dealer lives. But it also means we've now entered a new phase where actually used supply is tightening, because we're now bumping up against the 3-year anniversary of when all the supply chain problems hit the new vehicle market, and especially reduced leasing of vehicles, which is an enormous source of the wholesale market and used retail inventory that especially relates to what we see in the certified pre-owned market, which is a big and important part of franchise dealers' sales.
Jonathan, I want to ask you a question. If you were a dealer right now, right? Given what you know about the state of the market and potential headwinds and tailwinds, what would be, and you could wave a magic wand, right? Like, what would be the best, most optimal scenario to maximize, efficiency, profitability, just to create, to position yourself as an absolute, in the best situation possible in the market, in light of what you just mentioned about used cars, new cars, right? What I'm trying to understand here is like, what is the trifecta right now? Is it to be a specific franchise dealer carrying a specific type of used car at a specific price point, with a specific model, right? What is the best position that you could possibly be set yourself up right now to be best suited for the current environment?
Well, this is a wonderfully diverse industry with regards to what type of customer you're serving. And you can define that by the price point of the vehicles, the credit tier of the consumer, new emphasis versus used emphasis, brand that you focus. And so I don't think there's definitively one sweet spot. There are opportunities, and where you are in the country, geography plays an enormous role. Over 20 years in real estate taught me that location matters. And so if I'm a dealer, I'm thinking about doubling down on my market, really understanding my market, in some ways ignoring the talking heads that keep talking about a United States auto market, because the reality is we have 1,000 auto markets around the country, and what is happening in your specific market as a dealer may not resemble, what you're hearing in the aggregated news, and it can lead you to become too risk averse and worrisome about the future when your market is just fine with job creation and population growth and demand for vehicles. Obviously, the stores that you represent, if you're a franchise dealer, play an enormous difference because we have seen brands gaining share substantially this year versus brands that have struggled. I've dubbed it the revenge of the Japanese with regards to where the absolute strongest growth and profitability has been this year. And it's been a struggling year for Stellantis, which we're probably going to talk about. I would be investing in every way I could to be more productive. I would say that's a theme that's not unique to the vehicle market. Every industry is looking at what are the factors that are driving up my costs, and labor is a big part of our market. And the labor situation, when you look at simple demographics, we're going to run into a point that the population not only is no longer growing, but is actually declining in the next 20 years. Now, immigration can play a bit of a role on just how, do we truly tip into population declining? But believing that the labor force is somehow going to become easier to hire and retain individuals is highly unlikely. So being able to do more with less. And by the way, the tools that best in class dealers are implementing, whether it be off the shelf solutions from major names or investing in custom technology solutions, which a lot of regional dealer groups are doing, you basically have this scenario where you're not only becoming more efficient, but you're magically improving the customer experience, which draws more people to you. And I believe that will be a key part of what I would be doing as a dealer. And I would be also focusing on how do I get scale in my market so that my brand, means something to the consumer as a consistent source to think of, no matter what my niche is going to be. And I think that will continue to pay dividends. And that's how, if you're a small independent shop, that's how you defend your turf. If you're a local market franchise dealer or regional dealer, that's how you keep the nationals out of your backyard, is controlling your own destiny.
This episode is brought to you by my very own car dealership guy News. CDG News is here to help you stay updated on all things automotive. We're not your typical news crew. We're bringing you concise, unbiased car industry news in easy to digest formats. From the hottest headlines to podcast summaries, dealership best practices, and industry insights, we've got it all covered. And guess what? It's all free, no paywalls, just like we always promise. Hop over to cdg.news, that's cdg.news, and check us out. We're all ears for your feedback. Tell us what you need. Give us your honest thoughts. We're here to deliver real value. So don't wait. Head to cdg.news now or click the link in the show notes below. I want to pivot to just prices. We haven't seen much deflation on the new car side. Now we are seeing more incentives and rebates, not nearly, or I should say, and you can correct me here if I'm wrong, but it still has greatly outpaced inflation. The increase in new car prices. Used car prices have receded significantly. As you just mentioned, they've sort of found stability. A lot of that was driven by electric vehicles. So there's a big variance there. What do you think comes next on prices? Right. And when it comes and let's look at net. So let's factor rebates and whatnot.
Sure. So new car prices, it depends on what you're focusing on. So if we're focusing on what the consumer buys or what the BLS reports every month, that's the new vehicle part of CPI. New vehicle prices have come down about a percentage point year over year. So they've been deflationary over the last year. But when you drill into the data, what you actually see is the vehicle is not getting cheaper. The MSRPs are up year over year. The invoices are up even more than the MSRPs. So the key difference has been discounting has returned, but we're not seeing the same level of discounting we had pre-pandemic. Back then, the average what the consumer paid versus MSRP was about 6%. We're at roughly 3%. And actually this summer has been the time over the last 2 years that the rise in discounting has sort of plateaued. It has not continued to go higher. And I think that ties directly with what we've been seeing in new vehicle inventory. New vehicle inventories have actually declined modestly in the last couple of months, and days supply has been sticking to, in our numbers, which are a little bit inflated relative to what the OEMs report, but what we get off of the vAuto platform tells us we've been at a very consistent 80-day supply for most of this year once we got into tax refund season and since. And so if sales are modestly higher, it basically means that we are seeing a more disciplined, tighter market. And we seem to be establishing a new normal kind of at that level, which suggests that discounting may not quickly go back to the 6% that we once had. And you mentioned EVs. If you drill into the data by model, by brand, by powertrain, you take EVs out and you take Stellantis brands out, and you have a much tighter new vehicle market with very low incentives, or relatively low compared to even, what we had in 2019. And that's why, while dealer grosses on new vehicles have come down, we're not back to 2019 levels. It's still, it'll be the fourth most profitable year for franchise dealers in terms of their new sales, and the new department is a bigger share of profits for.
And why is that? What's the drivers of that?
That they simply are making more money on each new vehicle that they sell. When essentially we were, if you go back to pre-pandemic times, do you remember all the discussions about dealers may actually lose money on every new vehicle they sell, and that that story has been changed a bit with a market that's tighter on the supply side. So I think new vehicle pricing. You asked where we're going. I think we're likely to continue to see more of the same. We'll see some increase in discounting, but I'm not counting on a lot. So the consumer price is probably going to tread water. Some of that is also mixed because we're seeing a few more affordably priced vehicles launched, and that's especially true like in the EV segment. So the mix is going to keep that average price the consumer's paying and what the CPI is measuring from going up very much. But behind the scenes, vehicles are not getting cheaper to make. We continue to have very strong appetite for $60,000 plus vehicles in the mix because the luxury buyer and the high credit consumer increasingly make a bigger portion of the market. So the vehicles have more technology in them, more safety features in them. Plus, you've got huge increases in labor costs that essentially say, if you're betting on the MSRP coming down or the invoice coming down, that's not going to happen. So the new vehicle side is likely to tread water on what consumer is paying, but I would bet on MSRPs and invoices continuing to go up.
Mm-hmm. Talk to me about. Okay, so there's a couple things there. First of all, you mentioned that margins on the new side are still significantly higher. Dealers are making more money. It's driven by low supply. What are we tracking right now in terms of SAR, or for those that are not familiar with the industry lingo, right? Let's just say, how many new cars will we sell in a year? What are we tracking right now? How does that compare historically? And do you think it's going to stay where it's at or it's going to change?
So the year-to-date SAR is 15.6. It was 15.5 until we got through September, and it moved up to 15.6 with the September results. We believe we're going to end the year at 15.7, which requires the fourth quarter to be the strongest quarter of the year, and getting us to an average SAR in the quarter of 16 million in order to be able to do that. And I think the stars are aligning for that to be clearly within our reach. I think November and December in particular are probably going to be the strongest months, but some of that is also predicated on the manufacturers perhaps being more aggressive with incentives. I know in some of your recent episodes you've talked about if you were focusing on it, you would be moving more low interest rate deals to attract consumers that are sitting on the fence and represent some pent up demand that's ready to jump in when the monthly payment is right. And I totally agree with that perspective. And we haven't seen that happen, but I'm convinced we will in November and December.
Do you think the industry will go back to 17 million plus new vehicles sold per year?
That's a little bit harder to do in the short term because affordability basically has shrunk the pool of people who can buy a new vehicle in the country. And we believe the new consistent pool is more likely in the low 16s and not 17 million. Is it possible? Yes, but it goes back to that price of vehicle discussion, plus assuming interest rates and where they're going on the credit side. We'll get about a 10% benefit from where we think interest rates are going to be going over the next year to 2 years. But we really need a little bit more than that if you're going to get to 17 million and beyond. In our models today, our long range forecast out 5 years, we do think we touch 17 million again. But we think it's not going to be the next couple of years. We're going to be more solidly in the 16s.
Got it. So you're pretty much saying the price increases, like I said, have outpaced inflation, outpaced earnings growth or household income growth. And so that has pretty much priced out 7 to 10% of the market. And so, annual new vehicles sold is just, now just persistently going to be lower than what we've gotten used to in the past. If I'm an automaker, right, and we spoke about affordability, we see sort of where the industry is headed. And, in China, you have, some significantly cheaper electric vehicles that even if you put 100% tariff and brought them to the US, they would still be significantly cheaper than the overall market here. You have Tesla, which just did the robotaxi event. And even if it takes, several years to really start commercializing this and scaling this, that at some point over the next decade, there will be a reality where you have these robotaxis, starting to sort of be littered across the country and scale from there. So if I'm an automaker thinking long term, am I telling myself I need to move upstream with more specialization, differentiation in my vehicles because it seems like if you really forecast here kind of further out, that the entry level transportation in our market will eventually be solved by many different, whether it be robotaxis, rideshare, which already exists, blah, blah, blah. Doesn't mean people won't own cheap cars. They will, but a smaller percentage. So automakers in general, do you see them just moving upstream from here, focusing on more specialty vehicles, right? Investing in maybe finding their core competencies and whether it's interior design, technology, body style, I don't know what, but basically starting to have this long-term vision of just ditching the entry-level segment of vehicles?
I think that is what we've been witnessing happening to the new vehicle market in the United States. And by the way, as an economist, that's exactly what happens when you build up tariffs and restrictions to trade, because you mentioned China, but those Chinese vehicles are having an impact in other regions of the world, like South America are seeing huge success with sub $20,000 priced vehicles really resonating with consumers and also driving electric vehicle adoption. So I think as the die is cast right now, and it's not very likely on the political horizon, no matter what happens in the election, that we're going to see a radical change in the structure of the industry. I do think your hypothesis is right that new vehicle manufacturers are increasingly going to be focusing on more specialization. And that is especially true of the domestics, because that's why the Japanese are having such a killer year, because they and Volkswagen are the only ones that have affordably priced vehicles within their offerings, and along with the Koreans. And so it creates an environment where I think specialization is probably a likely continued, strategic emphasis. But if we were to really say, what is the optimal way to address transportation and affordability challenges for basic transportation for Americans, you would think twice about preventing the lowest cost solutions from being able to be offered in the U.S. And I have conversations with dealers who are experiencing owner groups who are experiencing what's happening, like in Brazil, and saying that they would love to be able to sell $15,000 EVs in this country if they had the chance to do so.
One of the craziest things about the Car Dealership Guy platform is our direct access to literally thousands of dealership and automotive employees. So naturally, I often hear this question: CDG, can you use your network to help me fill an open role at my company? Well, now I can. Building on the success of my free industry job board, I'm proud to launch CDG Recruiting, a more hands-on white glove automotive recruiting service. Whether you're looking to fill roles in dealership management, C-suite, F&I, fixed ops, auto tech, SaaS, we take the hassle out of hiring by doing the heavy lifting for you. And here's the best part: we vet and screen thousands of candidates so you don't have to. And with our placement guarantee, hiring through CDG Recruiting is 100% worry-free. Our team has decades of experience and has successfully placed over 1,000 roles in the automotive industry. So if you're ready to find your next rockstar employee, try CDG Recruiting today by visiting cdgrecruiting.com or clicking the link in the show notes below. Again, that's cdgrecruiting.com. Where do you see profitability for the industry trending, specifically with dealerships? Right? If you had to make a bet here, whether it rises, declines, and regardless of which direction it goes, what changes? What's your bet? What do you think changes here over the next 6 to 12 months?
So I think that we are likely to continue to see some erosion in the new vehicle grosses that dealers have enjoyed as we slowly see that supply situation revert to a bit more discounting that really also brings with it more volumes. I think total
is that all brands, or is that certain brands?
I think it's inevitably all brands, but it's going to play out in the near term more aggressively with the brands that have oversupply conditions. And by the way, powertrain. So EVs are going to for most dealers, they're not profitable now. And it's probably still going to be a few years before we really see the front end grosses being positive. But it's the percentage. That's one way people look at profitability, but it's also the total profits that you're making, because our forecast is that volumes will be growing finally, because we're starting to see affordability come down, and we are in a situation where we no longer have the same supply issues that really caused the industry to decline in the first couple of years of the pandemic. So the total amount of turn, the total amount of volume you can do will drive some growth in profits from a pure dollar perspective on the new vehicle side. On the used vehicle side, it's been a challenging couple of years because we've been going through the used vehicle price correction. So dealers buying used inventory and then turning them around and retailing them, they have had a more difficult time of maintaining what is normal used grosses. And by the way, are coming off of the year in 2021 when they made the most profits they had ever made on both new and used combined. So it's felt very challenging. But as I mentioned before, we think we are through with the used vehicle price correction timeframe, and with more predictable pricing and a tighter used wholesale and retail market, I think that's going to work to the favor of used grosses stabilizing, if not modestly improving. But then also we're forecasting growth. It's not huge growth because it's supply constrained, but it will be positive. So that becomes a bigger part of the equation. And then fixed ops has had a good couple of years and is destined to continue to do that because price inflation in parts and in vehicles and inflation in labor absolutely come together. in the fixed ops environment, but you match that up with the situation that vehicles today are more complex and more expensive. It means that minor repairs require more, higher tickets overall. But you also have the situation that we believe consumers are far more likely to go to the franchise dealer to have their work done. And that means that part of the equation, if you're a dealer that has service and repair, you're likely to continue to see very strong growth there. The one limiter to both the used and the fixed ops story is that the car park has not been growing much, and we have a lack of vehicles that are under 5 years of age, and that doesn't magically fix itself. We don't make new used vehicles. It takes time to matriculate through the marketplace. So dealers of all types are having to sell and service a slightly older used vehicle to maintain the same volumes that they once had.
And what's the broader impact of that on the industry? Does it have any impact on profits? I mean, on anything major, or is it just a little shift in operating?
Well, I think it forces discipline in the used car market, and we've had some challenging years that has caused the total number of stores, when you take into account major companies like Vroom and Shift that are gone forever, and then many stores, even like used cars only stores from some of the big franchise dealers, they cut some of those offerings. So you're down probably a couple of thousand retail points from where we were in 2019. And that means that the people who are left are capturing a bigger share of the marketplace as we start to grow again. But they've all had some challenging times, and I think collectively there's more discipline. And we see that in day supply continuing to be constrained and in line with being able to sell vehicles closer to a 30-day turn versus a 60-day turn. So I think dealers are far more efficient and far more focused on making sure they're profitable on the used car side as a result of that. The specific age issue is leveling the playing field a little bit to the favor of independents over franchises, because what's really falling to make the market tighter are off-lease vehicles. And those off-lease vehicles historically drive themselves, their previous owners drive them to the franchise dealer, turn them in, and in recent years, their trunk has been filled with cash because the vehicle itself is worth more in the market than the contract price that most franchise dealers can ground that unit at. Well, they're falling by 800,000 to 1 million over the next 12 months. And so franchise dealers are having to source inventory from other places that would be more expensive for them. It's a level playing field that I think independents are going to likely perform and feel a lot better than they have been over the last several years.
So tell me about auto lending a little bit. Like, how does that play into this broader picture? A couple of things that go through my mind. We see the Fed, cut rates a tiny bit. Then there was some positive data that came in, whether it was, you'll know better than me, whether it was household income or, job gains. There was, slightly positive data.
September job report. Yeah.
September job report. But then also, you see stuff like Q3 was a record quarter for EV sales. Can you reconcile all this for me? I'm trying to understand, is the market slowing? Is it not slowing? Are we just throwing money at, money on the hood? And that's what's driving, in this case, record EV sales, right? Like how do you kind of, reconcile this entire picture?
Well, yeah, there's a lot of moving parts in it. It's a complex story. And by the way, I think the next couple of months are going to be even more confusing because the hurricanes are injecting some noise that are going to make some macro metrics, including possibly the October jobs report, to look much scarier than the situation really is, because the hurricane hit in the week that the BLS uses as a reference point, and big chunks of Florida basically did not have people employed at the time those numbers were gathered. We'll see what that looks like. But basically, I think part of what we've been through for the economy has been a bifurcated experience where higher income consumers, which are the highest credit quality consumers, which tend to be the consumers who buy principally new vehicles, and especially those who buy electric vehicles, have been doing great. They own homes. They locked in mortgages at 3% or less. They own stocks, and they're at record highs. They own homes that have appreciated substantially. It's been truly the best of times. Then you look at renters, the other side of the story, who are lower income, median to lower, tend to be the subprime consumers and deep subprime consumers. They first were just obliterated by inflation, because the inflation that we've had over the last several years principally impacted three things: food, energy, and shelter. And those three things make up more than half of their household budgets. So instead of experiencing what at the peak, the CPI was 9%, those folks were experiencing 22% in inflation. It's really hard to juggle your bills and make ends meet at the end of the month when things have just gone up on you by 22%. So those consumers have been struggling. And while inflation has come down, relieving that pressure, guess what moved into its place? Record high credit card debt and record high interest rates on credit cards that are essentially the same effect on their bottom line, because every month they now have an interest portion of their credit card bill to cover that basically is causing them to fall behind on auto loans, fall behind on their credit card bills, you name it. So we see signals that the consumer is still under stress. Now, I am optimistic that the inflation battle is largely over, and we will continue to see progress there. The job market has remained strong, even though the pace of its growth has slowed to something that's far more sustainable over time. And then we have the situation with interest rates finally being cut. So you mentioned the Fed. The Fed cut 50 basis points. That's going to take some time, I believe, to show up in auto loan rates, but it's going to immediately show up in those credit card bills. And so I think in October, November, December, and hopefully there's a couple of quarter point cuts from the Fed coming. And certainly by the spring, you're going to see the consumer feeling better, having a better financial situation across the spectrum. And that's going to enable credit performance to improve. The lenders will feel more positive about getting more aggressive with the lending that they do in the auto space. So I'm optimistic we could see auto loan rates down by a full percentage point from where we are now by tax refund season, at just the right time when people are getting almost $400 billion flowing through the economy from just normal tax refunds. And some of that pent-up demand will come up off the fence and get ready to purchase. So I'm optimistic that this complex story is through its worst and will start to improve. And credit is absolutely central to it. You're very right in being focused on that.
Okay, now if I'm a dealer that's looking to grow my sales by 5 to 10%, or if I'm a consumer that's looking to get the best deal possible, is it still true that used EVs or new EV leases are still the best deals in the market? Yes, no, something different? Thoughts?
Absolutely. Twice the level of incentives, more discounting. In the classic, it depends at the end of the day. But if you're looking for the best deal, the best bang for your buck, a new EV lease is most likely to be the case. You can then go through the models and see where there are some very strong offers. And as I mentioned to you before, I'm convinced that manufacturers, and at least a handful of them, who are in a relatively oversupply situation are going to be trying to make the most out of the November, December market. And so I'm expecting some more attractive interest rate offers and some real opportunities on the new vehicle side. So I think you could see some really strong incentives on some pickup trucks even, because Stellantis certainly has enough Rams to go around right now.
So speaking of Stellantis, right before this podcast, I got a text from, there was a dealer council meeting for Stellantis in Detroit for 3 days. And it seems like Stellantis did a pretty good job because certain dealers are feeling pretty good after that meeting. One thing to note is I received one note that Stellantis is determined to continue getting their inventory down in a pretty meaningful way. Specifically a minimum of 300,000 units. And so, again, it's going to take time to get there. That's a big jump down from where we're at today, which you're talking about, or where we've been close to 400,000 or so. But nonetheless, it seems like the sentiment coming out of this meeting is pretty positive. I haven't seen that in about a year and a half. What is your take on Stellantis? Again, this is news that literally just hit my inbox in the last hour. And I'm curious to know what you think about the brand, its challenges, and really where it goes from here.
That's very encouraging because I've heard the most negativity over the last 2 years, and especially I think back to NADA this year in Vegas. The vibes coming from the Stellantis franchisees was not positive. So, what are the issues there? Fundamentally, it's been across everything: marketing, product, credit. Stellantis, in large measure, shifted to a much more expensive product mix that was not well timed with the trends in the marketplace, and especially for their traditional consumer, which they used to have multiple price points in Dodge and in Chrysler and in Jeep that basically catered to a consumer that is lower income and barely able to qualify for a new vehicle, and certainly had a disproportionate higher number of subprime consumers. So if you suddenly are replacing all of your Patriots and Compasses with Grand Wagoneers, there's a mismatch in what the market can give to you. And then you're up against a hyper competitive world where the brands in your segments, namely SUVs, full-size pickup trucks, are basically as aggressive as ever and launching new vehicles. So you have like the Ford Bronco really causing more challenges to Jeep than it historically has ever faced with the Wrangler brand. You just had really poor timing. And so what happened was the supply built up rapidly. They were one of the first of all of the manufacturers to solve their supply chain problems. But unfortunately, instead of selling the vehicles, the inventory just piled up. But then curiously, over the last year at least, and this is really where the reports that I hear from dealers who have Stellantis stores, dealers were very frustrated that they were not appropriately growing incentives to move those vehicles and get them off their lots. Well, guess what? Floor planning expense is at record highs because of interest rates. And that's awful for those dealers. And so I interpret that plan to reduce inventories and supply levels as one that means they're going to get really serious about moving those vehicles and growing their incentives in a constructive way. So it totally supports my thought that November and December could be two of the strongest months of the year.
That's good context. And again, I'm reading just some other text messages here. It seems like the North American chief, Matt Thompson, just seems way more, and I quote, comfortable, confident, and supported. So that's positive. Again, at least that's based on what I'm hearing. he has promised a retail strategy that's clean, consistent, and committed. Again, that's a promise. He's got to execute, but we'll see what that even means. Okay. I mean, there's a bunch of other stuff here. I'm gonna have to parse this out and really kind of dig into, thing by thing. But overall, it seems very positive. They've also done away with the volume incentives for dealers, where they were incentivizing dealers to actually, Stellantis to take in inventory. So dealers have, obviously, that's been well received, because that is, that's a nice little short-term sugar rush, but long-term, that's obviously very detrimental. So lots to go there. I mean, I think I don't want to dive too deep into Stellantis, but I do have one other question. Do you think that their inventory situation has implications to the broader market? I mean, are their challenges pretty confined to their performance? Like, do you think this materially affects the overall auto retail industry?
I don't think it is. Again, it's sort of like the observation that if you take Stellantis and EVs out of the data, the new vehicle market is pretty lean on the supply side and is showing no signs of bad behaviors with incentives, crazy lease deals that are upside down, or dumping vehicles into fleets. And so I think it bodes well that if this pocket that has been the one source of problem, and by the way, I think more of those problems landed on dealers' books that own those stores, as opposed to necessarily just directly in Stellantis's performance. So I think I do think it will materially improve the health of the overall market if they have more healthy patterns.
Now we're coming up here on election time. Everyone's favorite time of every 4 years, right? I'm curious to think how you think this can impact the industry. You did mention that you're forecasting a stronger Q4, but can you add anything to that? Consumer confidence, spending in automotive, are consumers going to gravitate, in your opinion, towards a certain type of incentive, whether it be subvented interest rates, rebates, anything specific? I mean, what do you think about this entire season in general?
Yeah. Well, one, let me share a positive fact that I'm seeing. We track a daily measure of Morning Consult from Morning Consult for consumer sentiment. It's the same questions as Michigan, but they ask far more people and they do it on a daily basis. So it's a really good, timely measure. We are officially at a 2.5-year high on that right now. So less than 3 weeks away from the election, consumers are feeling the best that they've felt since the spring of 2021. And that is very encouraging, because a key hypothesis I had is that no matter who wins the election, there's been this wet blanket of uncertainty, plus all the contentiousness that we've all been dealing with for more than a year now. And that goes away. So I do think that sentiment will be stronger, and it'll just add to the more virtuous cycle that I expect will be happening with inflation coming down, Fed cutting interest rates, and the overall economy being stronger, and especially perfect timing for tax refund season in the spring. Will this election bring implications for the auto market? Absolutely. Probably more than any election in recent history, because you've got major topics like tariffs on the table, which complicate and impact auto far more than any other type of industry. And depending on who wins, you either have status quo on the EV tax credits and the IRA and moving forward on the path to electrification, or we might see some of that changed. So I do think that there's clearly some dynamics that dealers and manufacturers are going to have to be prepared to react to. Now, I am not in the camp that believes that in either candidate winning is going to lead to immediate extremes. I do think if Trump wins, get ready for record EV sales, way more than the records we've been setting in November and December. Because if you're thinking about buying an EV and you're on the fence, then it makes sense to buy before any risk of that tax credit going away, if there is risk. But I think it's going to take time, because very likely we're going to have a divided Congress, whoever wins the White House. And that means that very few things are going to be done by the stroke of the pen. And even if you go back and look at what happened in the auto industry under Trump the first time, there was a lot of rhetoric that led to heavy negotiation and some things that looked scary at first, like tearing up NAFTA, but ended up finding solutions, negotiated solutions that were for the better for the economy and the industry. So I'm hopeful that we will navigate this. And so I think the uncertainty then becomes the super plus that it's out of the way. And
that's interesting what you mentioned about the EV tax credit. You're right, like being as a forcing function to get for incentivizing consumers to purchase earlier, sooner rather than later. Hypothetical question. First of all, we are, car dealership guys rooted in objectivity. So don't want to get political here. We're not picking sides, but I do want to get your opinion on, hypothetically speaking, if Elon Musk was coming on the pod prior to the elections, what would you want to ask him in light of what you just mentioned, with Trump being vocal about removing EV tax credits, Elon being a big supporter of Trump, and of course his business is, he's a big beneficiary of the tax credit. Any question you'd want to ask him? Anything?
Well, I'd love to have that chat about what would be the best designed tool to encourage EV adoption in a way that gives a positive return to the taxpayer. And I think he very likely has some strong opinions on that would keep Trump from doing something stupid, but also would reveal some thinking that would benefit us all to understand. And the second, I would love to dig into the robotaxi numbers. And if you can do a robo-taxi under $30,000, then can't we have an EV that's under $30,000 that can have a driver too? And a little bit of the dynamics on that side on why the shift to robo-taxi versus just traditional ownership as well. So if you get that lined up, please tell me when to listen in.
Yeah, no, it's great questions. All right, Jonathan Smoke, how do we wrap up here? So we spoke about the broader industry. We spoke some predictions. We spoke new and used. Where do we go from here? What are your closing thoughts?
Well, why don't we end with some music?
Let's go.
Because here we are. So the election theme, we were just talking about the election. I'll give you two election related songs. Tears for Fears, Everybody Wants to Rule the World. That's the next couple of weeks. But what comes after that to get rid of this uncertainty is a song from the 1960s, another politically contentious time frame from the Byrds, which is, I'll feel a whole lot better when they're gone, because at least half the population is going to be super happy in a few weeks.
I'll tell you something funny. Our team, we have like very strict guidelines on just certain things, how we write things and whatnot. And so it feels like over the last couple of months, everything we post, not everything, but certain things we post, it gets spun in some political direction. And it's crazy because we have to be so careful because, we want to stay down the middle. This is not our turf. We're automotive insights, but we literally have the election day on the calendar. It's I can't wait till the day after so that we don't have to walk this tight line of oh, you're trying to push a narrative. I could care less about pushing a narrative. Let us just talk about the car industry. But it's been very difficult because you post any word that people associate with one side versus the other, and it gets completely misconstrued. So so I'm sure many people listening are just let's fast forward a month and go on with our lives, which I really do believe is most of our country. But there's definitely a very loud minority on both sides, which makes it it just makes it a little bit difficult to do this stuff. So anywho, get any other songs on your plate?
Oh, there's plenty. You can always go to Spotify. DJ
give us one more.
Well, be prepared for changes. David Bowie. I've got a lot of change selections in my current playlist.
Jonathan Smoke, always fun chatting and always super insightful. Appreciate you coming on. We'll be in touch. We'll do another one in the future. All right. Hope you enjoyed that episode. Please give the podcast a rating, consider subscribing to the show, and check the show notes for links to what we talked about. Thanks for tuning in. I'll see you guys next time.